this recording, we're looking at disposing of an asset if a trade-in is provided. So a trade-in is when we want a new asset and that new asset might be $22,000 including GST. So in other words, $20,000, and we are told that our existing motor vehicle will be traded in for, say, $5,500, including GST, in other words, $5,000. So basically, off the purchase price of $20,000, they'll be taking the trade-in price of $5,000. So in your books, there is an example at page 34, and I want you to work through this example. It's pretty self-explanatory in the book. So I'm going to explain it to you without the use of numbers initially to start off with. So step one is very important. It's exactly like just the sale of an asset for cash or on credit. You have to record the depreciation to the date of sale. Step number two, you then must record the transfer of the asset to the disposal account, which is what we do in step number two. Step number three, we then record the accumulated depreciation and close that off to the disposal account. So nothing yet has changed. Where it changes is when we get to step number three. You'll see I've divided it and given you basically a 3A and a 3B. 3B, we told in the example on page 34 that the new asset is worth to us $20,000. The GST paid on that asset is $2,000. So the total price of that asset is $22,000. So you record it as if you were purchasing the whole asset on credit. But then you know that a trade-in has been given of $5,500, including GST. So as soon as you hand your motor vehicle over, $5,500 reduces what you owe the accounts payable. Hence, it's the liability that's being reduced on the debit side. The $5,000 goes to the disposal account because we are receiving that money to offset the cost of the asset. In other words, you are selling your asset for $5,000. So that is the only difference in the whole question, is step number three, and then how we record the sale in step number four. Step number five is still recording the profit, or in this case, the loss on the sale of the asset. And all of that, all five of those steps take place on the day you sell the asset. Remember, on balance day, you have to close off depreciation expense and the loss on the sale of the asset to the profit and loss account. Or you close off the depreciation expense to the profit and loss account, or the profit on the sale of the asset gets closed off to the profit and loss account on the credit side. Now, in the assessment question that you have to do, which is question number 25, there's something slightly different here. Here they say that they sell the asset, and they sell the asset for $14,300, including GST, and they sell it on credit. So you have to record $14,300 in accounts receivable. And you know that you have to calculate the GST on that. So 14,300 divided by 11 is 1,300. Therefore, the actual amount of money you're receiving for the asset is $13,000. But a deposit is paid of $1,000. So this $1,000 comes into the bank, $1,000, and accounts receivable goes down by $1,000. So the whole time, everything that we do in accounting, we just have to look at it in a very logical way.